the last time we met, we talked about alternative investment, different type of alternative investment. We looked at some part of alternative investment. So let's look at this part now. The fee and structures of alternative investment. Please, let's pay attention. I want you guys to get your pen and things to write. So if you're having any issues, please let me know. Please let me know.
There's one picture to it. You don't.
If you remember very well, we talked about private capital. Private capital, when we talked about private debt and private equity, different forms of investment and the early stage in when we talked about different forms of where you can invest. Hello, are we together, everyone? Okay, so as I was saying, there are three forms of investment. When you have an alternative investment, so it's usually different from the normal investment you do, which is the equity, buying equity and buying bonds. So if you are not buying equity and bonds, you are probably doing alternative investment, okay? Like we discussed the last time. So there are different ways, different investment methods in which you can invest. One of them is fund investing. There are three ways in which you can invest in alternative investment. One of them is fund investing. Another one is co-investing. Lastly, direct investing. So what is fund investing? Please, if you need to jot anything, please do. If you need to ask questions, but I will try as much as possible. The way to have summarize it for everyone. So what is fund investing? So fund investing is the simplest and most costly. So this is how it works. You as a sharp guy, you want to invest in alternative investment. What you just need to do is you will look for, the way we do mutual funds now, what we need to do is just look for a mutual fund, maybe a Stanbic IBTC or maybe any investment firm that accepts money. You understand? You just give them the money and go and relax. So what you are doing as an investor is you are providing the fund for them to invest on your behalf. So at this point, the investor contributes capital to a fund, and the fund makes investments on behalf of the investor. So what I do is, as a fund investor, I look for a fund, I drop my money, and the fund invests on my behalf. I don't need to think for them. They just do the investment, and what I just need to check is has my investment gone up? They added 2% last week. They added 5%. The way we do for mutual funds now, that treasury bills. Are we together, everybody? Hello? Please ask me questions, so please.
So we are saying mutual fund is a type of...
No, it's not. I'm just giving as an example. So I'm just giving an example. When we invest in a mutual fund, what we do for a mutual fund is we just drop our money and they invest on our behalf. So that is fund investing. Fund investing drops money for an alternative investment, so maybe a private equity, maybe a hedge fund, maybe a real estate. They now invest on your behalf. So that is fund investing. I don't know if it is clear now. Please ask me questions. Thank you for the clarification. Please ask me questions. That's why I'm here, please. I need to be sure that you guys are getting it. So what fund investing is, to bring out your money. What you just provide is the fund, is the money to the investment firm, and they invest on your behalf.
Okay.
So once they invest, they increase the fund, they increase the whatever, you get your rates and every other thing. So that is fund investing. The next one is co-investing. So co-investing. So probably as a sharp guy, you have worked with a fund and an alternative investment organization before. What you don't need to do is, since you've seen the technique and every other thing they do, you just replicate what the fund is doing. I don't know if you are following me. You replicate what the fund is doing. You now say, so this is the strategy they used to use to invest. So what you are now doing, you replicate what the fund is doing. Are we together, everybody? Talk anytime, please. I just want to be sure, I just want to be confirmed that you guys are with me. So direct investing. Direct investing is the hardest and the least expensive. What the person does is, you invest directly yourself. Maybe as a sharp guy, you just left school. from a university, and you feel that because you finished the first class and every other thing, you can invest in alternative investment yourself. So that is what this guy is doing. You are investing directly.
Good cop.
I want to get that. So this person is investing directly in the alternative investment fund himself. So let's look at the advantages and disadvantages. Please, that's right. For a fund investing, the advantage of a fund investing is requires low level of investors involvement. It requires low level of investor involvement, because what you're just doing is you're just putting down your money, they will invest for you. So you don't need to bother yourself at all. You don't need to bother yourself at all.
Good.
So next, access to alternative investment. Access to alternative investment. Access to alternative investment without possessing high degree of investment expertise. So you don't need to bother yourself. Once you drop your money and they're investing for you, that's all. You understand? So you have access to alternative investment techniques and so on. The next one is low minimum capital requirement. Since you are investing with other people together, you understand? You are investing with it's like a pool of funds they are using to invest for that. So you put a minimum amount, unlike you going directly to the place to invest. So the next one is disadvantages of fund investing. From what we've spoken about, it is costly. Looking at it, you are giving your money to them. They will charge you management fee, charge you incentive fee, and so on. So it is costly. It is costly, and it is costly to manage. You understand? So by the time you pay investment fee, you pay performance fee. Next disadvantage, investor must conduct due diligence. Investor must conduct due diligence, because if you want to invest in a fund, you have to make sure you ask around. So which fund now, or which alternative investment is very good, or which one will give me a high return, and so on. So investor must conduct thorough due diligence before investing. Investor must conduct thorough due diligence before investing. Let's move to co-investing. Co-investing has a reduced management fee, because what you don't need to do maybe is just pay a little amount of money to get maybe techniques or things to do. So since you are replicating what the fund is doing, you pay a minimum amount, a small amount. You understand? So investors can learn from the fund's process to become better in direct investing. So you've seen the way the fund works. What you just need to do is replicate what the fund is doing. You replicate what the fund is doing. So what else? Disadvantages. Sorry, please. I need to be confirming that you guys are fine. Disadvantages of co-investing. There is reduced control. May be subject to adverse selection. Look at this, for instance, now. You as a sharp guy, and you feel that you know very much since after replicating, and you're investing in the real estate, and you feel that, I have preference for houses in Ikoyi. You went to buy all your investments in Ikoyi. Let's say, for instance, now, Tinubu now comes, but probably you bought all your houses in Lekki. Someone now comes now and says that, we want to build a roadmap of Lagos that shows the bridge that will link Lagos and Calabar. We want to destroy all the houses in Lekki now, for instance. It's an example. So it will be a big issue for you, because you've adversely selected one particular place. You understand? Unlike if it is a proper fund investment, they will diversify. They might say, let's do some parts in Ikeja, let's do some parts in VI, let's do some parts in Songotedo, let's do some parts in Ibadan. So if worst case scenario, anything happens in Lekki, we still have investment in Ikeja. You understand? Unlike you, that you are probably biased and selecting, what's it called? Maybe Ikoyi houses or VI houses in Lagos. So that is co-investing. So direct investing. In direct investing, you avoid paying management, because you are directly going yourself. You avoid paying management fees. You don't pay management because if you are personally investing yourself, You are personally investing yourself, so you will not pay management fees.
For people.
So the next is highest level of control, because I'm the direct person. What I just need to do is I just control. I'm totally in charge. You get. So it has the greatest amount of flexibility also. It has the greatest amount of flexibility.
Yeah, I got it.
It has the greatest amount of flexibility. So since I'm direct, I can decide to buy, sell. This time around, I'm not buying. I just want to keep my money. So since it is a direct investment, I can decide to buy or sell or do whatever I like with it.
Yeah, I got
So one of the disadvantages of it is you have less access to funds. Since I'm going directly, there will be minimum amount in which I'll be able to get. There will be a small amount. It's just going to be a small amount. It's going to be a small amount. So since I'm going directly, they might say to buy a real estate, to get into a real estate investment trust is maybe 70 billion. Probably I'm going as an individual. Before I could raise it, maybe I was able to raise 1 billion. But if I'm going as a group, or maybe as to be able to what do I need to do? I'll just call 10 people together, 7 people together, and they'll be able to raise the funds for me. So that's it. So we have 3 forms of investing: direct, co-investing, and fund investing. Please, any questions so far?
That's it. That was
Okay, thank you very much. Please hope we are all following. Please, if there's any issue, this exam is too simple for we to be struggling, please. It's too simple for we to be struggling. So if, for instance, now let's say you want to invest in a hedge fund, I'm going to be giving you some terminologies now. Let us write it down. Please, it's very important. We will use it to solve questions in hedge funds. Please, I'm going to give you the maximum question we can solve in hedge funds, and we'll be fine. So there are different partners, different partnership structure. Imagine if you are investing in an alternative investment, there are 3 sets of people. I'm for instance, now I want to drop my money. I'm dropping my money. You understand? I'm dropping my money in an alternative investment firm. So I'm the outside investor. Are we together? I'm the outside investor. The outside investor drops money in an alternative. Let's say the outside investor drops money in a hedge fund or a private equity firm. So the private equity firm will now invest in companies. You can see I've named 3 people now. There's the person that has the money, the big man that has the money, is investing in an alternative investment company. The alternative investment company collects pools of money. They now start investing in different companies. Are we together, everybody? So we have 3 sets of people. There is a company. The person invests in an alternative investment, and the alternative investment now invests in different companies. So we have 2 types of partnership. There's a general partner. Let's write it. General partner and the limited partner. The general partner and the limited partner. So the general partner is the expert, the fund manager. Is the fund manager responsible for managing the funds. Responsible for managing the funds. The next is the limited partner. The limited partner. The limited partner are outside investors. The limited partner are outside investors who provide capital to the fund. So the limited partner are the owner of the fund. They put money in the general partner while the general partner invests in companies. Makes sense, everybody? Are we together, everybody? So let's continue. So you can see from what I've said so far, we have the investor, which is the limited partner. The limited partner invests in the general partner, which is the alternative investment firm. Then the alternative investment invests in small companies. Look at, for instance, now, while I'm talking about this example, as have you seen Skybank? When Skybank was a listed company. So, for instance, now, there are some private equity firms. What they look for is a distressed firm. It's a distressed company. It's a distressed company. So they go and they have their own analysis. They plug it into their own analysis and see that it is worth it to invest in that company. See that it is worth it to invest in that company. When their share price is down, they buy. They rejig the company, make it very attractive, they sell at a high price. So when they took over Skybank, a private equity firm took over Skybank, what they first did is this: they took up their management, sacked all their management, took up their management. I will explain all those things here. When they took up their management, they now started rejigging the company. They rejigged the company. They are still rejigging it. So it might take like 5-6 years. When the company is now very, very nice, very, very okay, they might now sell it off, recoup their money. Maybe they bought it as at that time at 1 billion. They will recoup their money and sell it maybe as maybe when they are selling maybe 12 billion, 13 billion USD and recoup their money and they sell it and they are off. So that's what those private companies do. Those private equity firms. Please, if you have any experience in any of these things, so you can just probably talk about it so we will talk about it. So, how does it work? How does it work? So one thing about alternative investment, you have to be smart because there are rules and terms that you might not be able to understand. So if you are going there to probably involve in alternative, you bring maybe a lawyer or somebody that knows that industry very well. Take the person along and let the person explain to you, or else they will just cheat you and you are off. So let's go. So compensation structure, please. Everybody hold your pen and let's write. Compensation structure. One of them is management fee. Management fee. So the general partner typically receives a management fee based on asset under management. Asset under management is the total amount you have received. The total amount you have received based on asset under management. The total amount you have received. So for instance, now let's say they give you they are giving you what's it called, 2 billion now. They just tell you, they are dropping 2 billion for alternative investment to invest for you. What you just tell them is, okay, this 2 billion, I'm charging 2% of 2 billion. 2% of 2 billion. That is the management. That is the management. That is the management. So another one you can also see is performance fee, or incentive. Some call it performance, some call it incentive. So this performance fee, so as the funds is growing, as the money they've invested as is growing, the profit on it, they will now collect a percentage on the profit on that. The general partner, they will collect a percentage on the profit on it. That is called performance fee. So as the fund is making much more money, they will collect extra percentage on it. So you as a sharp guy, thank you very much. You as a sharp guy, you know that, okay, performance, you want to collect performance fee and the funds will drop. So you will now tell the person that, oh, I will give you performance fee only if you cross what is called order rates. Please, let's note that, order rates. So you will tell the person, except you cross a 20%, you cross 20% more than the profit you're expecting, that is where you get your performance fee. Please, let's note. Wow. So let's write, the general partner earns fees, that order rate now, high order rate. Order rate. Order rate. A order rate is typically based when it's typically paid, that's for you to pay the performance fee of a general partner when the general partner exceeds a hurdle rate. So there are two forms of hurdle rate. There is the hard hurdle rate and the soft hurdle rate. The hard hurdle rate and the soft hurdle rate. So for the hard hurdle rate now, the general partner earns a fee on annual return. The general partner earns a fees on annual return in excess of the hurdle rate. In excess of the hurdle rate. A hard hurdle rate, the general partner earns a fees on annual return in excess of the hurdle rate. In excess of the hurdle rate. So it is only when it exceeds that particular return, that's when the person can claim performance fee or incentives. Soft hurdle rate. Soft hurdle rate.
But inside,
Soft order rate. So the soft order rate, the general partner earns a fees on the entire gross returns. And the entire gross returns as long as you exceed the capital. As long as you exceed the capital.
audited and
As long as you exceed the capital.
you remember
As long as you exceed the capital.
it, but how you know,
As long as you exceed the capital.
then the thing that
So there are other clauses which a limited partner can include in with the general partners agreement, this LPA,
the answer is one
limited partner agreement.
of the state because for that you
One of them is catch-up clause. Let's note catch-up clause.
to be great to
Catch-up clause.
that
Catch-up clause.
state when you're not keeping, you know, you're back using soup on a
Catch-up clause.
good thing. Address it, let them say, but how I
So this allows the general partner.
is
This allows the general partner to catch up and receive. This allows the limited partner. This allows the limited partner to catch up with the general partner. This allows the limited partner to catch up with the general partner. The limited partner receives 100% of the distribution. The limited partner receives 100% of the distribution above the order rate. Above the order rate generated. Above the order rate generated. So for instance, now let's say the amount you have dropped is 100%. You have said that until I get that 20%, that order rate. So all the profits that the 100% is making, the limited partner will collecting it. The limited partner will collect everything first until you exceed that 20%.
for times
Once they exceed that 20%.
question
So the next one is high watermark. High watermark. High watermark. Very interesting. Let's say for instance now, the amount to put is 100 million USD. And the general partner makes a profit and the money goes to 120 million USD. So now, for the general partner to collect another performance fee, the general partner must exceed the initial target they have made. That is the 120 million USD. So, so let's say, for instance, now, the general partner next year makes 110. The general partner will not get anything. Next upper year, the general partner makes 105. The general partner will not get, except now exceeds that 120. That's when it will get, what's it called? That's when it will get another performance. So let's say, for instance, now, high watermark, you as a sharp guy, you don't want any general partner to cheat you. You put 100 million USD in an account. You have not told the person, except you exceed your initial performance target, we will not give you any other performance bonus. So initially, the person put 100, the money goes to 120 million USD. Next year, the person makes 110. If you don't exceed that initial target, the general partner has exceeded, there is no performance or profit sharing for you. So waterfall. So this describes the way the distribution will be made to the limited partner. So this is how the limited partner will be distributing the profits, the income on that investment to the limited partner. So there are different forms. There's something we call whole of funds, which is European waterfall. Let's note that whole of funds, WHOLE, whole of funds, which is European waterfall.
positive
European waterfall.
5 okay
Then the next one is deal by deal basis. That is American waterfall. Deal by deal basis, American waterfall.
let's see on the thousand like those
A deal by deal basis. American waterfall.
It's like,
So what is hold of fund? That is that European waterfall. As that is right, as deals are exited, all distribution go to the limited partner first. All distribution goes to the limited partner first. All distribution goes to the limited partner first. All distribution goes to the limited partner first. The general partner does not participate in any profit. The general partner does not participate in any profit until the limited partner receives their initial investment. Until the initial partner receives their initial investment and the order rate has been met. And the order rate has been met. And the order rate has been met. The next one is deal by deal basis, American waterfall. Deal by deal basis, American waterfall. So, performance fees are collected on a per deal basis. Performance fees are collected on a per deal basis. So who wants to tell me which one will favor the LP and which one will favor the GP? Is it the whole of fund or deal by deal basis? Sure.
American waterfall should pay the general partner.
American waterfall will pay the general partner. It is more advantageous to the general partner because as they are exiting their deal, you are collecting your profit. As they are exiting their deal, you are sharing the profit with the LP, while the whole of fund will benefit the limited partner. Thank you very much. Thank you. Look, are we good? So that's it. So that's the whole story they were talking about. But if there's time, we'll try and see if we can go back to all these questions. So that's the whole story. So investment returns now. Investment returns.
It's right.
Investment returns. Investment returns. So basically for any alternative investment firm, there is something we call J-curve. You can see this is it. J-curve. So usually almost all, in fact, all alternative investment funds, they are usually lost first. They are usually lost. You can see that it's in loss before it now start becoming profits. They are usually lost. So once you put in your money, they will need to rejig the firm. They will need to rejig the firm first, adjust the company. By that, so they want to employ the best MDs, employ the best hands, adjust the company. Once the thing is now making sense, they will now sell it off. There's something we call J-curve. You can see this is the J-curve. You can see the J, the way it is going. It is coming as below the line. It is below the line first before it's now start coming up, and the return is now very okay. So there are 4 stages. There are 3 stages in a what? In a J-curve. One of them is capital commitment. Capital commitment. So alternative managers, they look for an organization. They look for people that have the money. They look for people that have the money. During the capital commitment stage, the money is usually a loss. You can see the capital commitment stage is usually a loss. You can see it's usually a loss. The next is capital deployment. So once the person brings in the money, once you bring in the money, they will now deploy it to different companies and readjust the company, rejig the company. At that point also, the company is also making a loss. The investment is also making a loss. So the companies start making profit when they start doing capital distribution. You can see capital distribution. It is when it is in that capital distribution, the returns start becoming positive. You can see capital distribution. So this is the turnaround strategy. when the startup companies now start making profits. They start making enough profits. So let's go. Everybody get your pen. So this is the maximum question they can give you in terms of maybe your private equity and stuff, maybe your hedge funds and things like that. So I want you all to pay attention. So AWJ Capital is a hedge fund with 100 million of initial investment capital. It charges 2% management fee based on year-end asset under management and 20% incentive fee. In its first year, AWJ Capital has a 30% return, assuming management fee, and calculated using end of period. Number one, what are the fees earned by AWJ if the incentive and management fee are calculated independently? And what is investors' effective return given this fee structure? So we're told that 2% management fee. So it's going to be 2%. Let's calculate the management fee first. So what's our total amount invested? What's the total amount invested? Oh yeah, now. What's the total amount invested? Yeah?
100 million.
100 million. What's the return? Return is how much?
30%.
30%. So our what will get is 30% time. So it's going to 1.30. So our total amount at the end of the period is what? 130. I don't know if that's fine.
Thank you, Mark.
Our management fee is how much? 2% times what?
Great.
Where now? So they were told that it's calculated at the end of the period. So it's going to 2% times 130. So what's our management fee? Where? Hello, are you guys there?
2.6 million.
Thank you. 2.6 million. Thank you. Please don't mute your mic. Please talk to me. Now, incentive fee. Incentive. So how much is our incentive fee? At what rate?
2. Good files.
20 piece.
Thank you. 20%.
20%.
So you're going to 20% times 130, which is the amount of clothes minus the initial amount of use. We are do 130 times minus 100 times 20%. So what we are?
It's all that.
6 million.
6 million. Thank you. Don't meet your mind. So this is our incentive fee. So the total fees is how much? The total
8.6.
Thank you. That is 2.6 plus 2 is 8.6. Thank you. Thank you. So now let's continue. We're now told to calculate effective return, investors' effective return. Investors' effective return. So investors' effective return, you remember that stuff you did in your equity, which is P1 minus P0 divided by P0.
Hello?
Yes, I can hear you.
Okay. That's 26%.
Now what?
Okay, you can go ahead. Sorry.
Okay, yes, you calculated it already. Thank you very much. Please don't mute your mic. Let us continue this way. So our effective return is going to be 130 minus 100. Talk to me. Minus what? Minus 8.6 divided by what? 100. So what do we have as our investor investment? That is 21.92%. Hello, are we fine? Did you get it?
What you get? 2.1?
21.92. 21.92, which is 22%, but if you approximate.
Go 21.4% though.
Oh yeah, so how did you calculate it? So yeah, talk to me.
130 minus 100 minus 8.6.
Yes. Oh yeah.
Divided by 100.
Oh yeah. 21.40, Abi.
Yes.
Thank you. That's the answer. Thank you so much. I think I used the wrong thing. Okay. So 21.40. Thank you for calling up attention. 21.40.
that's what you want to do. Love it. It's a shot. I did what else?
Let's continue. Let's make sense, Abi. You can see it's quite easy. So let's move to question 2. Okay.
It's not.
So let's go. We're told that next one, what are the fees earned by AWJ, assuming that the incentive fee is calculated from the return net of management fee. Net of management.
What? Shit.
So how do we go about this one? Yeah, talk to me. How do we go about it? Let's calculate our management fee first. What's our management fee? Where 1 year, 50% to 130 times 2%, Abi?
Right.
Yeah, which is 2.6 million. Now let's calculate our performance fee.
Good.
Performance fee.
Yep.
Okay, let me go ahead. You can see that we're doing that. Our investors said, they said our incentive is calculated net of management fee. So incentive fee will be what? See, this is incentive fee. Are we together? It will be
That's right. Good.
130 minus 100 minus net of management fee minus 2.6 times 20%. Yeah, that's our incentive. You can see now. Make sense now, Abi?
Obviously,
Are you there?
you were because of one kind of people.
So what do you have? What do you have? What did you calculate?
So, with the very which that it wasn't, but and but our capital actually return
5.48 million.
5.4 pay. Now, from here, now, what's now our total fees?
there's some sort of writing.
Total fees what?
A million though.
Eh?
So the best
It's 5.48 million.
Yes, I get. So what's now our total fees?
like the cost I yeah, it's hard to compare is
What's our total fees now?
like whatever
Management fee plus incentive fee. So what do we have?
that's like the cost
8.0.
8.0. Yeah.
I did it. It's good.
8.08. Now let's calculate our investors' return. What's our investors' return here? It is going to be 130 minus 100 minus 8.08 minus 8.08 divided by 100.
Makes sense. That
So what do we have?
look the top 100. That's what it's like at if
22%, sir.
Yes, 21.92, which is 22%. Okay.
check the that's
Thank you. So that is how they got. So let's do for number 3. Let's do for number 3. Yeah, let's continue. Please don't off your mic. Don't mute your mic. Yeah. Number 3, let's do it together. So it says if the fee structure specifies a hurdle rate of 5% and the incentive fee is based on return in excess of the hurdle rate, what are the fees earned by AWG as assuming the performance fee is calculated net of management fee? Net of management fee.
just doing
Oh yeah, now. So what's our management fee? Our management fee still remains what? That talk to me. Our management fee still remains what?
6.
2.6. Yeah.
2.6.
Yeah. So now let's calculate our incentive fee.
good. In that part that
So yeah, let's go now. So what's our incentive fee? It has net of management fee, then it has hurdle rate. So let's go. Our incentive is going to be 130 minus 100 minus what? Our hurdle rate. What's our hurdle rate?
so this one have you
Our hurdle rate is 5%. You can see it's there. Hello, are you still there? Can you hear me?
Yeah, it's 5%.
Yeah, it's 5%. So it's going to be 5% times 100. That's the initial amount drop, which is 5. Minus the incentive fee, 2.6. So what's our total incentive fee? Yeah. Our total incentive fee is what?
good. Things
22.4.
Eh?
in the question. 22.4 million.
No, incentive fee.
130 minus 100 minus 5.
That is 130 minus 100 minus 5 minus 6 times
So 5.
times the 20%. What is our incentive?
What's good? 4.48.
Thank you. 4.4. So from here, your total fee without the 2.6 plus 4.48. Then from there, you can calculate your investors' return. I mean, can you calculate your investors' return from here? What's your investors' return? Oh, yeah, tell me now. Talk to me.
26%.
Oh yeah, now 20.
Good day. 26%.
No. So how did you get your investors' return? Talk to me. How did you get your investment? You know the total fees now. This management is 2.6 plus this 4.4. You get when you add it up 2.6 times plus this 4.4 is put that.
Good job here.
It's now 7.06. Yeah.
So that's 23%.
23%. Is that what you got? Thank you.
Yes.
That's 22. How do we actually show me how to calculate it? Talk to me. Which is going to be what?
That's
130 minus 100 minus
100
divided by what?
minus 7.0.
Thank you. So what now is now going to be what? 22.
23.
Okay, 22.9 or 33. Thank you. Makes sense. You can see it's quite interesting. It's quite interesting. Once you know it, you are fine. Once you know it, you are fine. So let's give run through the other alternative investment. Then we are probably going with the friendly investment. It's a very short topic. You can see that investment then the calculation will later in the model. When everybody's brain is very refreshed. Very refreshed. Very interesting.
Yeah. Okay. Well,
very refreshed.
Step. Step. Good. Right.
So are we good? Yeah. So another calculation apart from what we'll be saying is called multiple of invested capital. Multiple of invested capital. Multiple, which is called MOIC. So from here you can see that MOIC is the realized
What?
realized value.
What's that?
Realized value of the investment plus the unrealized value divided by what? The total amount of invested capital. Let's take note. MOIC is the realized value of investment plus the unrealized value of investment divided by the total amount of invested capital. Are we together? Realized value.
Okay. That's what happened.
So look at this example for instance now. Okay. So this is it. Can we all see the screen? Example. H is a private equity firm. Makes an initial amount of 3.8 billion in year 0. So what is the formula again? Oh yeah, remind me now. Yeah. The formula is realized amount plus unrealized amount divided by total capital. So yeah. So we know that H, the private equity, makes an initial investment of what? 3.8. Is it part of capital? That's 3.8 is part of capital. The next one is 8 years later, it sells stake for how much? 8.5. So 8.5, you are selling your stake, that's part of your realized stake. 8.5 is a realized value. 8.5 is a realized value. The next is what? We're told that additional capital invested is what? 3. Additional capital invested in year 3 is what? 1.2 and 200 million respectively. So additional capital invested is 1.2 and how much? 200 million, which is 0.2. So the total amount, the realized amount is 8.5 divided by our total capital, which is 3.8 plus 1.2 plus 0.3. So what's our MOI?
With banks being like which the embrace and
1.6.
we can that was
1.63.
intentional the second thing about it's like we should cover by the like eat it
1.63.
so it did I guess like you I kind of other stories the job it's like it's in structure lesson if I actually the part of the boots are like they keep to the black is that current and like
Makes sense, I mean everybody. Okay, so let's continue. So that is one of them. We can use MOI as another form of performance appraisal for our so that is MOI. So that's how they got 1.63. So another one is IRR. IRR, we can use IRR. We've done that with our what's it called, corporate issuer, which I will still revise when we get back to corporate issuers very soon. Then lastly, you can use your leverage, you can use your borrowed fund. Leverage position, borrowed fund. So how does that work? So they wrote a very funny formula here, but I will simplify it for you.
yeah sure
I will simplify it for you. So what is the formula?
you can take the action thing for the fish
You always told me the whole thing. Please, here now is leverage funds. Return on leverage. Return on leverage.
drop this one from talks do you have a pen
Right? Leverage. So it's going to be what? It's going to be the return you get, the return you get on investment, plus the leverage position divided by what? Cash. Cash position.
right
Into bracket the return
change
minus cost of fund.
fine
We are fine. This is the formula you need. That is the leverage position. You can see there's a very straight formula the curriculum has written here. So, but that is what they are just trying to say. So, we'll try and use it to do example. Now, please, you can jot it down so it will be easier for you to remember when you are doing your revision. Instead of struggling with this big formula curriculum has put here.
Return minus cost of fund.
Exactly. So that's what we use to solve it now. So let's do the same example here. You can see. So let's see. So let's do it. Let's use this example to solve it. So L Opportunity Fund Limited, a hedge fund that uses 100 million of capital as leverage. That's it. 100 million, that is a 100 million of capital, which is cash, Abi,
let's go with that
which is cash.
that's what that was early here
Scenario 1, suppose underlying position, the return is 8%. So yeah, let's start imputing our figure. 8%, return is 8%, Abi, which is 0.08 plus, what is our then added leverage? Our leverage is 50 divided by cash of 100. Abi, then we're told that our cost of funding is 4%. What is our return here? 0.08. Cost of funding is 0.05. So what's our answer? That this is 0.08. Instead of looking at the formula in curriculum, in my struggle with football, have simplified it for you here. Oh yeah, now what's the answer now?
yeah we were
as a type of it.
looks like actually that each that like actually now unlines
Eh? 10%. Okay. 10%. Sweet. Sweet. That's it. That's it. Just understand the formula So let's do scenario 2. Scenario 2. Let's do scenario 2.
But gonna be happens.
Let's do scenario 2. Let me rub this up. So the same formula to return plus leverage divided by cash into bracket return minus cost of funds. Yeah.
Expects the those. It's in share.
Let's do scenario 2.
The kind. That's it. That's
Suppose Lucas underlying position incurs a loss of 2% of the earnings. Have it?
Sure.
So 2%, we are now 2%. So what was our returns? Due to be minus 0.0. Have it? Plus what else? What's our leverage?
Okay.
And then what would have been the leverage
I bet that's not
Okay.
return?
Steps.
If it had borrowed 50, so leverage return is what? 50. What's our cash? 100. Into bracket, what's the return? Minus 0.02. What again? What's the formula? Minus what? What's now our cost of funding here?
Understood.
Our cost of funding still remains 0.04. Here, 0.04. What's our answer? To be careful of minus sign when we are solving this. We're solving 5%. Thank you.
stop.
Is that interest? That is.
Because
So that's it. That's it for alternative investment. The other alternative investment which we've spoken about earlier, we could have other ones, timber, digital assets, and so on. We've spoken about this one when we first started. So I don't say to so complete so that I think people running from this stuff, which is that exactly. Please, any question on alternative investments that you are struggling with personally, you can let me know. This is an avenue. Please ask me.